Today, we're doing a complete breakdown of Indian Accounting Standard 37. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before Indian Accounting Standard 37, companies often struggled with uncertainty around provisions and contingent liabilities. Imagine that your business faced a potential $10 million lawsuit. How would you account for that? Indian Accounting Standard 37 offers a clear framework for recognizing and measuring provisions, ensuring financial statements reflect economic realities. By the end, you'll grasp how this standard brings clarity and consistency. Indian Accounting Standard 37 was crafted to solve the dilemma of inconsistent recognition of provisions and contingent liabilities. Imagine two companies facing similar lawsuits but reporting them differently, an investor's nightmare. This standard ensures that obligations are reported accurately, reflecting true economic realities. It prevents firms from understating liabilities, misleading stakeholders. Understanding Indian Accounting Standard 37's origins helps grasp its critical role in financial transparency. Indian Accounting Standard 37 is a must-follow for any entity preparing financial statements under Indian Accounting Standard, effective since April 1, 2016. It mandates recognizing provisions only when a present obligation truly exists, not merely a possible one. This standard demands that companies assess the probability of an outflow and that they can estimate it reliably. It's about ensuring that liabilities are neither overstated nor hidden, providing a clear picture to stakeholders. The core model for provisions under Indian Accounting Standard 37 is pivotal for financial transparency. It requires entities to recognize provisions only when a present obligation exists and can be reliably estimated. This model ensures clarity by differentiating provisions from contingent liabilities, which are merely disclosed. Interviewers might ask why this distinction matters. It's about providing an accurate financial picture by recognizing only probable outflows, preventing overstated assets or understated liabilities. Scope determines what Indian Accounting Standard 37 applies to and what it doesn't. Candidates often forget that future operating losses are not covered by this standard, and that's a classic interview trap. Understanding the scope can save you from costly mistakes and missed liabilities, like not accounting for a $200,000 warranty provision correctly. Indian Accounting Standard 37 covers provisions like legal claims, where the timing and amount of liabilities are uncertain. If your company has a pending lawsuit that seems probable, it's crucial to recognize this as a provision. Warranty provisions are also critical. For example, if you sell products with a 1-year warranty, you must estimate and account for potential repair costs. Provisions for restructuring costs are recognized when a detailed plan is announced, ensuring all stakeholders understand potential financial impacts. Understanding exclusions is key to mastering Indian Accounting Standard 37. Future operating losses are not recognized, as they don't stem from past events. Contingent liabilities that are probable are also excluded. For instance, if the probability of a lawsuit loss is below 50%, it's not accounted for as a provision. Assets are not included until realization is virtually certain. This standard also avoids recognizing general risk reserves, as these are based on speculative future events. Provisions in Indian Accounting Standard 37 may seem complex, but they're essentially liabilities with uncertain timing and amount. If your company anticipates a $100,000 lawsuit cost, even with uncertain timing, you must record it as a provision. This ensures financial statements reflect potential obligations accurately. Provisions arise from past obligations, like warranties or legal claims, and require you to make the best estimate using available information. They offer a realistic view of future financial outflows. Contingent liabilities are intriguing aspects of Indian Accounting Standard 37. They arise from past events, but only become obligations if certain future events occur. Consider a pending lawsuit. Its outcome decides if it becomes a liability. If the likelihood of an outflow is above 50%, you must disclose it. Understanding this distinction helps in accurate reporting. For example, a court case with a 40% likelihood of loss isn't recognized but should be disclosed to maintain transparency in financial statements. Edge cases can trip you up with Indian Accounting Standard 37. Environmental fines, for instance, require a provision if compliance issues exist. For contracts, if penalties are likely due to a breach, they should be recognized. Tax disputes present another scenario. Record them only if outcomes are probable. Lastly, guarantees given need careful assessment. If the counterparty is likely to default, recognize a provision. Navigating these edge cases with precision ensures your financials stay accurate and compliant. Imagine a company facing potential legal claims or warranty obligations. The core model for provisions and contingent liabilities provides a structured approach to quantify and report these uncertainties. By applying this model, businesses can effectively recognize and measure financial obligations, enhancing transparency and decision-making. This is fundamental for stakeholders relying on accurate financial statements. The core model guides companies through recognizing and measuring provisions, crucial for accurate financial reporting. Our example features Meridian Corporation's $10 million SaaS contract with Acme Incorporated. This model will examine how obligations like Meridian's are identified, assessed, and reported, ensuring stakeholders see a true representation of financial commitments. Let's see how each step builds toward this clarity. The first step is identifying obligations arising from past events. Meridian Corporation's $10 million SaaS contract with Acme Incorporated involves obligations related to both software delivery and service commitments. Missing obligations tied to industry norms can lead to underreporting. Indian Accounting Standard mandates that obligations must result from past activities, not future events. Here, Meridian's obligation includes delivering $8 million worth of software and $2 million in services, setting the stage for further analysis. Next, we determine whether obligations are present or constructive. Meridian Corporation's $10 million SaaS deal includes distinct obligations for software and service delivery due to clear contractual terms. Confusing non-binding promises with constructive obligations can lead to errors. Under Indian Accounting Standard, constructive obligations occur when past actions create expectations. Here, the $8 million software license and $2 million service components are confirmed obligations. Once obligations are identified and classified, assess whether resource outflows are probable. Meridian Corporation must evaluate its $10 million SaaS contract with Acme Incorporated to determine if fulfilling software and service obligations is more likely than not. Misjudging likelihood without sufficient data is a frequent error. Indian Accounting Standard specifies a greater than 50% chance for probability. Here, Meridian Corporation finds both components likely, facilitating the reliable measurement of provisions. With obligations identified as probable, the next step is reliable measurement. Meridian Corporation estimates costs for its $10 million SaaS obligations, including potential risks. Ignoring cost variability can result in underestimations. Indian Accounting Standard requires that provisions reflect the best estimate, accounting for uncertainties. Meridian Corporation calculates the likely expenditure for each component, ensuring both the $8 million software and $2 million service obligations are covered, enabling accurate financial reporting. Finally, provisions require regular review and adjustment for accuracy. Meridian Corporation must reassess its $10 million SaaS contract provisions to incorporate new data or circumstances. Neglecting updates results in outdated financial statements. Indian Accounting Standard mandates reassessment at each reporting period to ensure accurate reflection of obligations. By reviewing and adjusting its $8 million software and $2 million service provisions, Meridian Corporation maintains transparency and accountability in its financial reporting. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions, but it's not just about numbers. Disclosures can shape investor confidence by revealing the assumptions behind those figures. Indian Accounting Standard 37 ensures provisions and contingencies are not just numbers, but informed, transparent decisions. Recognizing provisions involves more than just spotting an obligation. You need a present obligation due to past events, a probable outflow of resources, and the ability to make a reliable estimate. Suppose a legal case with a probable obligation of $500,000. You would recognize this as a provision, impacting both your balance sheet and income statement. Subsequent measurement ensures provisions reflect current realities. If new information emerges about a provision, adjust its carrying amount. Long-term provisions are discounted to present value, with unwinding increasing finance expenses. For a $1 million provision due in 5 years, estimate its present value and adjust annually. This ensures balance sheet accuracy and insights into financial health. Provisions must be clearly shown on financial statements to convey financial obligations accurately. A $200,000 provision for restructuring might appear under non-current liabilities, but is explained thoroughly in notes. Here, detail the nature and timing to provide clarity. Changes such as reversals directly affect profit or loss, highlighting how management adjusts to new information or outcomes. Disclosures offer a window into management's strategic thinking. By detailing the nature of obligations, like a $300,000 warranty provision, you help stakeholders understand potential financial impacts. Timing disclosures reveal when cash outflows might occur, aiding in liquidity planning. Discussing uncertainties and assumptions highlights managerial judgment and transparency. Lastly, expected reimbursements, like insurance recoveries, provide a fuller picture of financial risks and benefits. Imagine a CFO dealing with a $2 million legal claim, assessed at a 60% chance of settlement. They record a $1.2 million provision, reflecting the probable outcome and ensuring financial statements show realistic liabilities. By disclosing the nature and potential timing, the CFO provides stakeholders with vital context. As the case develops, the CFO revises estimates, maintaining transparency and accuracy in financial reporting, which is crucial for investor trust. Meridian Corporation, a global manufacturing company, faces an environmental obligation from a recent factory expansion. Discover how each accounting event unfolds, from initial recognition to financial statement impact. This comprehensive analysis showcases the nuanced application of Indian Accounting Standard 37 in real-world scenarios. The recognition of a provision for Meridian Corporation's environmental obligation stems from Indian Accounting Standard 37's requirement to account for obligations that arise from past events. By debiting environmental expense and crediting provision for environmental obligations, the company acknowledges its responsibility. This impacts the financial statements by increasing liabilities and reducing net income by $500,000. Adjusting the provision for inflation reflects the requirement under Indian Accounting Standard 37 to ensure provisions are updated for expected changes in costs. Meridian Corporation increases its liability by $25,000, which simultaneously raises environmental expenses, ensuring that the provision reflects current monetary values. This adjustment highlights the proactive financial management necessary in dynamic economic conditions. Indian Accounting Standard 37 mandates regular review of provisions to ensure they reflect the best estimate of expenditure required. Meridian Corporation's $10,000 adjustment accounts for changes in the cleanup scope or costs, highlighting the provision's dynamic nature. This adjustment underscores a commitment to financial accuracy and transparency in reflecting liabilities. By capitalizing the environmental obligation as part of the asset's cost, Meridian Corporation adheres to Indian Accounting Standard 37's guidance on asset-related obligations. This transforms the provision into an asset, affecting future depreciation. This maneuver aligns the financial representation of the asset with its true economic cost, offering a comprehensive view of company resources. Utilizing the provision for cleanup activities results in a decrease in both the provision and cash accounts. Under Indian Accounting Standard 37, this entry reduces the liability as actual expenses are incurred, reflecting the transition from obligation to action. This entry not only impacts cash flows, but also marks a significant step in fulfilling environmental responsibilities. Reversing the unused provision aligns with Indian Accounting Standard 37's guidance for derecognition once the obligation is extinguished. Meridian Corporation's reversal of $335,000 signifies the completion of obligations, improving profitability by reducing environmental expenses. This entry closes the chapter on the provision, reflecting effective project execution and financial stewardship. Every Big Four and investment bank interview on Indian Accounting Standard 37 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. A provision is a liability of uncertain timing or amount. Indian Accounting Standard 37 requires recognizing a provision when there is a present obligation, probable outflow of resources, and a reliable estimate. Common mistakes include confusing provisions with contingent liabilities. Remember, provisions are recognized, whereas contingent liabilities are disclosed unless the likelihood of outflow is remote. Record a warranty provision by estimating future repair costs and recognizing it as an expense at sale time. Indian Accounting Standard 37 requires this to reflect the true liability. Companies often underestimate, impacting profit figures. Accurately estimating ensures financial statements reflect expected future cash outflows. This transparency aids in decision-making. An onerous contract is a contract where costs exceed benefits. Under Indian Accounting Standard 37, recognize a provision for the unavoidable costs exceeding expected benefits. The trap here is overlooking indirect costs. Proper recognition reflects the financial burden, guiding management in renegotiating or terminating burdensome contracts for better resource allocation. Indian Accounting Standard largely aligns with international financial reporting standards, but differences exist, such as in terminology and disclosure requirements. A notable variation could be in the alignment with local laws and practices. Interviewees often neglect these subtle differences. Understanding these nuances ensures compliance and maintains credibility in financial reporting under different standards. Provisions are recognized liabilities. Contingent liabilities are possible obligations disclosed only if probable. Indian Accounting Standard 37 differentiates based on certainty and measurability. Many confuse the two, leading to misstatements. Clarity on recognition versus disclosure is crucial. Provisions affect the balance sheet, while contingent liabilities impact footnotes and risk assessment. Calculate by estimating direct costs like termination benefits and contract terminations. Indian Accounting Standard 37 mandates recognizing only direct costs resulting from restructuring. Avoid estimating indirect costs or hopeful recoveries. This ensures provisions are realistic and support strategic decisions, like cost-cutting measures needed to improve efficiency and profitability. Recognize contingent assets only when realization is virtually certain. Indian Accounting Standard 37 emphasizes reliability. Companies often prematurely recognize, skewing asset valuation. This misleads stakeholders about potential inflows. Recognizing at the right time ensures financial statements reflect genuine economic benefits, aligning with prudent financial management and investor expectations. Disclose the nature, timing, and uncertainties of provisions, including assumptions and expected financial effects. Indian Accounting Standard 37 mandates transparency to aid user understanding. A common oversight is inadequate detail, which can obscure risk exposure. Detailed disclosures build trust and enhance financial statement reliability, crucial for informed stakeholder decisions. Yes, environmental provisions fall under Indian Accounting Standard 37, covering obligations arising from past events. Some mistakenly exclude them, thinking they're regulatory. Recognizing these provisions ensures accurate financial representation of liabilities related to environmental cleanup or restoration, crucial for compliance and corporate responsibility. Indian Accounting Standard 37 guides the recognition and measurement of provisions, contingent liabilities, and assets. It covers entities outside financial instruments, taxes, and employee benefits. Provisions are uncertain in timing or amount and need a present obligation. Contingent liabilities arise from past events but are not recognized on the balance sheet. Contingent assets need virtual certainty for recognition. Constructive obligations come from entity actions, while legal obligations stem from contracts or laws. The core model under Indian Accounting Standard 37 mandates a present obligation, probable outflow, and reliable estimation for provision recognition. Provisions are best estimated, factoring in risks and uncertainties. Future events are relevant if they provide evidence. Discounting applies when the time value is significant. Reimbursements become separate assets, limited by provision amounts. Contracts deemed onerous when costs outstrip benefits require provisions. Restructuring needs a detailed and announced plan for recognition. In interviews, highlight the importance of meeting recognition criteria to avoid inaccurate provision reporting. Be aware of subtle differences between Indian accounting standard and international financial reporting standards. Disclosures must cover provision nature, timing, and uncertainties. Sensitivity analysis is vital for understanding provision risks. Measurement involves dealing with estimation uncertainties and dynamic circumstances. Have strong evidence for obligations, and accurate forecasting is crucial for forming reliable estimates. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.